Hey guys, Toby Mathis here, and today we're going to talk about how much money you need to retire. Question get all the time, and you see a lot of writing about it, and there's a lot of different theories on it. I'm going to go over kind of two big ones. Number one, it's the 4% rule that we're all kind of used to. I'm just going to share out a screen here so you can actually see it. Here we go. And I'm going to show you how they work out the 4% rule. Usually what they'll do is they'll say you take how much you need to retire. So let's just say you need $50,000 a year. It's real simple. They multiply that by 25, which is going to give you a number. I think this is 1.25 million. And that's going to say basically 4% of this number equals $50,000 a year. Now, there's a lot of people that'll tell you that that's the wrong way to do it because we're not factoring in taxes. We're not factoring in a number of things. Plus your lifestyle, it may want to increase. So if you're doing the 4% rule, you're going to probably run out of money at some point if you actually need the $50,000 because you're going to need to actually take more than that 4% out every year to cover taxes plus lifestyle creep, inflation, etc. So people see the end of their money in their 80s and they can see the end of it and they start stressing out. And I don't know if that causes them to pass away early, but I'm sure it doesn't help. So that's number one. So I'm not a big fan. I'll tell you what I am a fan of in a second. All right. Fidelity also has some simple rules, and I'm just going to share out Fidelity. I would let them do the talking themselves. So how much do I need to retire? Let's just share that out. And they have guidelines, and they say 10x your income by the age of 67. Now, the reason I'm not a big fan of this one is because I don't know what your income is, right? I have no idea, like my end income or the income that I have when I'm 30, right? And they're going to say, oh, whatever income you need to live off of. So really, you should calculate your expenses. So I would say, how much expense do I need to have? Then that's probably going to be closer to the amount that I need to have. Again, you have to factor in taxes because they tax Social Security. But let's just go through this. They have it pretty simple. They say you should have at least 1 times your salary by 30, 3 times by 40, 6 times by 50, 8 times by 60, and 10 times by 67. And pretty simple rules. And I like simple rules, but I don't think it's actually really that helpful. And the reason why is all of these kind of presume to be a spend down. So if I have 10 times my salary, so let's say that I in 30 and I'm making $100,000, then I should have $100,000 put aside. At 60, I should have 8 times. And let's say I'm making $200,000, so I should have 1.6 million. And then same 200,000, 10x by 67, that's 2 million. And what does that presume? That I'm going to take $200,000 a year out? Because if I have 2 million, that's 10% that I'm taking out. I'm not even factoring in tax and lifestyle creep, right? I'm going to probably have to downsize my life if I am trying to use this formula. And 10%, I just don't think it's realistic. And like when you look at it in retirement, the S&P historically has returned 10%. So I could do that over a long time horizon. But what I'm actually able to draw out and I'm able to guarantee, that's going to be kind of stressful. Because what if the market fluctuates? What if we have a 2008 where the market goes down 38%? You have 2 million set aside and you just lost $720,000. You had a big move of 38%. Now you're sitting on 1.2, 1.3 million and you're freaking out because you're supposed to be living off of 200,000. You could always go to your utilities and your and your expenses, maybe you have a mortgage or whatnot, and you say, hey, could you just wait until this economy bounces back? They're very accommodating. No, that doesn't happen. And that is why I always look at it and say, I'd rather have an income rule. I'd rather not sit here and dink around with a multiple of how much I have saved. I tend to calculate how much you need and how much income is being generated off of something. And I use 5 income sources. I just use rents, royalties, dividends, interest, and short-term capital gains from doing covered calls on my portfolio. And the reason that I do that is because if I have enough income coming in off of those sources, again, rents don't go down. Like maybe year over year might be a 1 or 2%. You never see like a huge crash in rents. Even in 2008, I had rental properties. Rents didn't go down. Rents actually went up because all of a sudden everybody needs a place to rent because they're losing their dang houses. And that was when Wall Street figured out, well, wait a second, those are cash cows. We're going to go in and we're going to buy everything up. And they really entered into that market because it's so lucrative, because you have this income and every year rents go up, just like home prices go up, just like incomes go up. Inflation is this hidden tax that's pushing everything up. But it can be to your advantage. That same tide that's rising is rising the value your boat. It's rising your rents. Interest is the same type of thing. If I have loans out there, 20-year, 30-year loans, 10-year loans, whatever, I'm getting an interest rate year after year after year after year, right? And it's going to continue to pay out. I'm not diving into that principle. I'm not spending it down. So what are the different forms? I mentioned dividends. I like dividends because for a lot of you guys in retirement, if you're married, for example, it's less than, I think it's 96,000 every year. It goes up a little bit. It's right around 100 grand plus your standard deduction. So it's closer to 130,000. You're in the 0% tax bracket on qualified dividends. You're not paying tax on it. Well, but I get this income. I have to pay tax. No, there are tax-free types of income. There's muni bonds and there's capital gains, there's borrowing against your portfolio. That's one of the hidden gems that a lot of people don't even realize. That you can borrow against your portfolio at a lower interest rate. Like I remember interest rates below 2%. To use your portfolio as collateral to go buy something that then generates more income. So you can actually use it as an albatross to go out there, possibly do rental properties, do things like that. Or if you just need money to live off of and you don't want to have a tax, you borrow against it. That's what a lot of the really wealthy folks do, is they lever their assets and they're constantly borrowing against those assets and levering up and letting the asset pay itself back. So like, again, some of you guys are used to doing this in real estate. You buy your house at 200,000, it's worth 500,000. You've already paid off the mortgage. You go get a $200,000 loan. It's tax free. Eventually you pay that off. If it's a rental property, it's easy. Like I'm not a big fan of mortgages, but I am a big fan of letting my tenants pay off a loan on a building if you have it. So you let them pay it off 20, 30 years later, 15 years, whatever it is that you're using as a payoff, you can go do that again. You never had to pay tax on that money. The income that's coming in sometimes is taxable. It depends. The old rule in real estate is if you're paying tax on real estate, it's because you don't own enough of it, because you use depreciation to offset it. But you're continuing to compound these things. And I'm looking at what it's generating. I'm not looking at what it's worth. A lot of us were so focused on our net worth. And net worth to me is really kind of meaningless. What I care about is how much income is being poured out so I don't have to work. In other words, I'd rather have a net worth of $1 million that is paying me $100,000 a year than have a net worth of $2 million that's paying me $80,000 a year, right? I would rather be having something that is producing cash flow, because that's ultimately what we use to live off of. I like the only way that my $2 million house, and I'm sitting here really proud. The only way I tap into that is either borrowing against it or selling it. And when you're in financial straits, you don't want to be in a situation where you have to sell it, because you might find that $2 million house, just like people in 2008, 9, 10, 11, 12 did, is they found out, well, hey, when I'm forced to sell it, whatever that market will bear. And maybe that $2 million house is only worth $500,000 right now. And I don't want to be forced into a situation where I have to sell it. So let me show you some numbers that are going to freak you out a little bit. This is what I would say doing in the alternative. And I'm going to share out a screen here. I'm going to share a calculator with you guys. And I want you just to kind of watch these numbers. This is just a little projector I use that I like to use. And I'll show you how these numbers work. So let's just say you are making $100,000 a year. I'm going to show you how powerful this is. It's going to freak you out. So if I am following the system I use is the Infinity Investing System. It's a book that I wrote, Infinity Investing. If you want a free version of it, by the way, just type in free book down in the comments below. And I'll send you a link so you can get a free version of Infinity Investing. Why do I do it? Because it makes me feel good. It was a gold medal winner. It was a bestseller on Amazon. It's still great. It's still going out there selling for 30 bucks a book, but I'll give you a free version because you're watching my videos. Like and subscribe. How about that? But just put that down in the comments and we'll send you a link. Let's just say that you're following our strategy and you're investing 10% of your income. So I have $100,000 coming in. That means I'm putting in let's just make it easy. I have $10,000 a month coming in. I was making it $120,000. I'm just going to put $1,000 monthly contribution. I'm doing my 10%. How about that? Makes it easy, right? After 10 years, I have 202,000. You're going to be saying, yay, that's not getting me anywhere, Toby. In 10 years, I only have 202,000. Well, that's not bad. If you're like doing that from 20 to 30, you're already ahead of what Fidelity is telling you, right? But here's the secret sauce. If all I did in the next 10 years, I took that the 202,160, this little number down here, and I just contribute that, and I make zero more contributions. And all I do is I just let it follow S&P average returns in its history. Like recently, it's much higher than that 10%. I'm not even looking at dividends or doing covered calls on it. I'm just looking at its just raw appreciation, which historically about 30% of the gain is dividends. It depends on which area you look at. Sometimes it's lower, sometimes it's higher. But I'm just saying we do another 10 years. We don't even contribute anything else. Now we're up to 542,000. So again, play along with me. You did this from 20 to 30, and now you never invest again. So you just invested and put aside money for 10 years. Then let's do the next. So we did from 30 to 40. Now let's do 40 to 50. We put our 542,733, and we put it aside, and voila, we're almost up to 1.5 million by the time we're 40. Oh, wait, we haven't contributed anything else. All we're doing is letting our money compound. Correctamundo. We're not even touching it. We're just letting it continue to grow. Well, but what if I need some of that money? Borrow against it, okay? But the investment is what we're talking about. It's not going to, we don't want to draw this down. Now, we're at 1.45, Watch what happens again. So we went from 20 to 30, only time we actually put money in. We went from 30 to 40, 40 to 50. We're sitting at almost $4 million, right? This is why I don't like looking at the 8x times your income. I want to have substantially more. I want to have a legacy. All I did is put money aside for 10 years. And then I just did that for a multiple. I did that for 30 years. Boom. And I end up with a lot more. So first 10, 20, 30, 40 years. All right. So now I'm sitting here probably about 60 years old, and I'm sitting on a big chunk of money. But let's just say first year we have zero. We're going to go ahead and we're going to put monthly contributions of $1,000 aside. We get up to our 202. The next 10 years, I'm making $200,000 a year. Maybe I'm putting $2,000 aside, and I'm going to let it even compound faster. So that is, I'm 20 years in, I'm now 40 years old, and I got my $1 million put aside already without really breaking a sweat. I'm putting a small portion of my income aside, $2,000 a month. If I'm making $200,000 a year, that's $24,000 a year. And then letting it compound, just letting it do its thing. And then I do that again. So now I'm going to do 947,053, but now I'm not making $200,000 a year. Let's say I'm making something more, but I'm just going to put $2,500 aside. Boom. What am I going to be at? $3 million bucks. And I did that within 30 years. That's not uncommon. And again, that's the net worth. What I care about is what it's generating. If all I did was covered calls, let's say my appreciation, I'm going to make that 7%, and I am doing some covered calls, and I'm bringing in 3% a year. I have if you go look at Kevin Simpson, Capital Wealth Partners, he does something called Devo. Their numbers are better than this on a many billions of dollar basis. They're doing about 13%, and probably 4% is covered calls. It's kicking out some money, plus they probably have, let's just say 1% dividend, 2% dividend, something like that. You see some serious movement, but it's kicking out income. It's kicking out dividends and covered call premium. This is the secret sauce. I call it being a stock market landlord. If all you do is rent the stock out to somebody else, give them the opportunity to pay you more. It's called covered calls, but I call it being a stock market landlord. You can be making somewhere in the neighborhood of 0.5%, 1%, some people that are active. I have clients that are doing this that are making 1%, 2% a month in addition to what their typical appreciation is. And before you say, but you're going to get called out, you can roll out of that. It depends on how active you want to be. You want to be lazy? You could let somebody else do it. You could just go do Kevin Simpson's Devo and let somebody else manage it. This is probably where you're going to be. It's actually a little bit higher. His return, I think it's right around 12%, 13%. Let's just say it's 8% appreciation. Yeah, now we're at 12. You're seeing some pretty significant income being generated. And again, this is one stock that's producing appreciation, which is non-taxable unless you sell. You can borrow against it. It's producing dividends, which are, these are qualified dividends, they're taxed at your long-term capital gains rates. And you're producing covered calls. And the covered calls is ordinary income that's coming out to you, but it's income that's being generated. And I'm just showing you a 10-year stretch. This is why people who learn to invest and learn how to save properly, which just means putting a small amount aside over a long period of time, they end up so much better off. And we're not playing around with what's my net worth. We're going far beyond that. We don't want 8x our income. We want to have many, many more. We want 20, 30x. If I did this, I should share this out again. I'm just going to show you what happens if you do this over a longer period of time. Let's just say that all I did was put aside, I started at zero. I made $1,000 a month. I know some of you guys are like, I don't have $1,000. Okay, whatever you're going to start at. I'm just going to say, let's say we're averaging $1,000 a month. We're going to do it over a 40-year stretch. So let's just say that it's from 25 to 65. And we have, or it's actually about 11% what the S&P's returned in its history. And I'm not going to mess around with anything else. This is all we do. I call the simple life hack is put your account on automatic, where it's just putting it into an ETF portfolio. And by the way, you could do much better than this if you actually pay attention to it. But this is kind of fun. And you just forget your password and you just pretend it doesn't exist. Money goes in, you're just constantly saving. You're going to be sitting on, just statistically, this is using these numbers with just appreciation, a portfolio of 8.5 million. And remember, Fidelity's telling you 8x at 67. This is if you were 25 to 65. Now, some of you guys say I have a shorter period of time. Okay, maybe we have 30 years. You're still at 2.7 million if you did it over 30 years. What if we increase this amount? Historically, let's say that I put 1,000 a year for a few years, then goes up to 1,500, then 2,000, 3,000, 4,000, whatever it is. Let's just say it's 2,000. I'm at 5.5 million. This is why you look at longer time horizons. Now you say, Warren Buffett, billionaire, how did he get there? This is how he did it. He was probably a billionaire right in his 50s. He did it for 50 years. Watch what these numbers do. 51 million. If you just consistently put money aside in hopefully a tax advantage account, which is great. If you can get a Roth. Maybe you're putting it in maybe you're doing a mix of real estate where you're not having to pay tax because you have 1031 exchanges and you have depreciation and stocks, whatever it is. Statistically, you are going to be retiring with many, many times your income. But again, that's not what I focus on. What I focus on is the income that is being produced off these assets. I have clients who have really small bases. Like, for example, I have a house in Indianapolis. I think we paid $17,000 for it. We made it into a boarding house. I used pad split and I rented out the rooms. Right now, it has 4 bedrooms that are renting for, on average, $200 a week. It's just over about $880 per room. So just over $2,500 a month, minus management fees and some expenses, it's right around $2,000 a month that is generating. The amount of my basis in that property is less than, it was like 17 grand, right? But I put some furniture and things like that in it to make it into a pad split, fix it up. Let's just say it's 50 grand. I am producing a 50% return on that. And you're not going to do that right out the gate. You're buying things and everything's going up, and rents are going up. Everything's going up on that thing. I could borrow against it and let my tenant pay it off if I wanted to do the leverage. If you want to be Grant Cardone or Kiyosaki, that's what they do. They're levering their assets to continue to buy more, letting appreciation do its thing, let rents go up, and they're snowballing. You can do that too. So whenever anybody asks me, how much money do I need to retire? I say, how much money do you need? Let's buy assets that pay that, and that's what you need. Whatever you can get those assets for. If you do it over a longer period of time, your actual cost for those assets is really, really low. As whenever you talk to anybody who's older and you say, how much did you pay for your house? They're going to tell you, oh, I bought my house for $25,000, such and such, or $10,000 or $100,000 or $200,000. And now it's worth $2 million, depending on where they're at. It's always about the time in the market. It's not about timing the market. It's time in the market. That's an old saying. And there's a lot of validity to it. There's tons of truth. But what I do is buy assets. And I want my clients to buy assets that produce income. And then how much do I need? Enough assets to cover your expenses so that you can live the way you want to. Those assets will continue to compound. And if you're retired for 20 years, what you're going to see is your portfolio still growing. And you're just living off of the fruit. I think it's Dave Ramsey that says, live off the eggs, not off the goose, right? It's the same thing. You want to be living off of the income that something is generating. By the way, Dave Ramsey's very conservative on a lot of things. He's very right. Consistently doing something small, consistently putting 10% to 15% to 20% of your income into investments, and you're going to have a fortune when you retire. Statistically, that's what's going to happen. Don't believe me? Go read. I think it was Chris Hogan, one of the folks that he works with, did a study about 10,000 millionaires. The top three categories, it was accountants, engineers, and teachers. Teachers, because they have these 401ks, they teach for 30 years where they're putting the money aside. They're not messing around with it. And then magically, when they retire, they have this big pile of money sitting there. Why are they're the millionaire? Why? Because they did something consistently over a long period of time. That's it. And the results are absolutely magical. That's compound interest. Anybody who's a serious investor is going to tell you that. Anything else, there's some guidelines. Hey, 8X, it's 25 times your income, 4% rule. Get rid of that stuff. What really works is putting money aside in assets that pay you, the right types of assets, rents, royalties, dividends, interest, short-term capital gains. You buy something that's generating one of those, whether it be oil and gas, or you're investing in notes, you're investing in the stock market, you're investing in rental properties, you're investing in REITs, whatever the case. And it's producing those types of income, and you do that consistently over a long period of time, you are going to be having a phenomenal retirement where you're not worried about money. You're playing the game of, oh, shoot, you're living up to right how much you're making, and you're not putting money aside as though it's a bill. You're going to end up at 60 and going, I don't have enough money. And that's a terror. Like, oh, shoot, I'm not going to be able to retire. There's so much of ease of mind and well-being of knowing I have enough coming in that I never have to work again. I'm already there. And I have a ton of clients that are there. There are a ton of people that we've worked with Infinity that are there. And they all say the same thing. They work harder now because they like to versus they have to. And that anxiety is gone because they already know. Now they're just looking at their legacy. What am I going to do? How am I going to change society? How am I going to benefit my family? How am I going to benefit the people in the organizations I care about? That's really what a fulfilling retirement's about. Okay, I've talked enough. If you could like and subscribe, I'd love it. If you want that free book, just type in free book. And more importantly, for all of you guys that have been through this, tell me maybe you're in retirement. Maybe you've done some of these strategies we're talking about. Can you give me your experience? Can you reinforce what I'm saying to the folks out there that are just learning, maybe some young people especially, so that they have a little bit of hope, so they're not sitting there feeling like they don't have $1 million or some sort of loser, right? So that they see, hey, there's wisdom in the idea of doing small things over a long period of time. Put that down in the comments below. Like and subscribe. Share this with anybody you think would benefit, and I'll see you later. Thanks, guys.